Divorce is one of the most financially complex events a person can face. The decisions made during this process can shape the next chapter of a life for decades. Welcome to Advisor in Your Corner, the podcast for individuals navigating the financial realities of divorce in California, and for the attorneys, mediators, therapists, and coaches who support them. Your host is Alex Weinberger, a certified financial planner professional and certified divorce financial analyst, bringing clarity to the questions that matter the most to you without the jargon. This is Advisor in Your Corner.
Today we're talking about one of the most frequently searched, most commonly misunderstood, and most financially consequential questions that comes up in a divorce. What actually happens to retirement accounts? This is a topic I care deeply about because I've seen firsthand how often it goes wrong. Not because people are careless, but because the rules are genuinely complicated, counterintuitive in several places, and the stakes are high. The decisions made around retirement accounts during a divorce can affect your financial security for the next 20 or 30 years. So let's take our time with this one and get it right. Before we get into the mechanics, it's worth understanding why retirement accounts deserve this much attention. For most married couples, retirement accounts represent one of the largest financial assets they own, and sometimes the largest. We're talking about 401k plans, 403b plans, pension plans, individual retirement accounts, profit-sharing plans, and deferred compensation arrangements. When you add them all together across both spouses, these balances can easily reach hundreds of thousands of dollars. In many of the cases I work on, the total is well into the millions. And yet, in my experience, retirement accounts are often treated as an afterthought in divorce negotiations. People pour enormous emotional energy into decisions about the family home, and then rush through the retirement piece in the final stretch of the process. I understand why. The house is tangible. It's where your children grew up. It carries emotional weight that a 401k statement simply doesn't. But from a pure financial standpoint, the retirement accounts often matter more. Here's the other reason they deserve careful attention. Unlike a bank account, you can't simply withdraw money from a retirement account and hand it to your spouse without triggering serious tax consequences. The rules governing how these accounts can be divided are specific to each account type. The paperwork required is specialized and takes time to prepare and process. And if any step is missed or done incorrectly, the financial damage can be significant, and in some cases permanent. So let's walk through this carefully. The first question most people ask is a reasonable one. My spouse never touched my retirement account. I earned that money. I contributed every dollar. Why should they be entitled to any of it? The answer, in most states, depends on when the money was contributed. In California, assets accumulated during the marriage are generally considered marital property, regardless of whose name is on the account. That means if you were contributing to your 401k during the years you were married, those contributions and all the growth those contributions generated are typically considered a joint marital asset subject to division. Money you had in a retirement account before the marriage is a different story. That's generally considered separate property, meaning it belongs to you and may not be subject to division. The same principle can apply to inheritances you received and kept entirely separate, or gifts that were never commingled with marital funds. The practical complication is that most retirement accounts are a blend of both. You may have had a balance before you got married, continued contributing throughout the marriage, and all of that money has been sitting in the same account, growing together for years. Separating the marital portion from the separate portion requires a process called tracing, and it can get complicated quickly, particularly in long marriages or in accounts with significant premarital balances. This is one of the first places where working with a certified divorce financial analyst adds real, measurable value. Identifying exactly what portion of a retirement account is actually subject to division versus what's protected as separate property can meaningfully shift the numbers in a settlement. It's worth getting that analysis done before you agree to anything. Now let's get into the mechanics. This is where things get specific and where the most common mistakes happen. The rules for dividing retirement accounts are different depending on the type of account. There are two major categories you need to understand. The first category is employer-sponsored retirement plans. These include 401k plans, 403b plans, pension plans, and profit-sharing plans. To divide these accounts as part of a divorce settlement, you need a specialized legal document called a Qualified Domestic Relations Order. In this field, we refer to it as a QDRO. A QDRO is a court order that instructs the plan administrator at your employer to pay a specified portion of the retirement account, or a specified portion of the future benefit in the case of a pension, directly to the former spouse. The QDRO has to meet very specific legal and plan requirements, and every retirement plan has its own rules about what language it will and won't accept. This isn't a standard form your divorce attorney fills out in an afternoon. A QDRO has to be drafted carefully by someone who specializes in this area, reviewed and pre-approved by the plan administrator, and ultimately signed by the court. The process typically takes several months, sometimes longer, and it needs to be initiated based on the terms agreed to in the divorce settlement. The second category is individual retirement accounts, or IRAs. These are divided differently and the process is somewhat simpler. Instead of a QDRO, the division of an IRA is handled through what's called a transfer incident to divorce. The divorce decree spells out the terms of the division, and then the financial institutions involved coordinate a direct transfer of the specified portion into the receiving spouse's own IRA. When done correctly, there are no taxes owed and no penalties assessed. The money simply moves from one account to another. Pensions deserve their own conversation because they come with an additional layer of complexity. A pension isn't a pot of money sitting in an account. It's a promise of future income, typically paid monthly for the rest of the employee's life after they retire. So when you're dividing a pension in a divorce, you're not dividing a current account balance. You're dividing a future income stream that hasn't started yet, and that may not begin for many years. There are two primary approaches to handling this. The first is called deferred distribution, sometimes referred to as the shared payment method. Under this approach, when the employee's spouse eventually retires and begins receiving their pension payments, the former spouse receives their designated share at that time, paid directly from the plan. This approach requires no upfront trade-offs, but it does mean the non-employee spouse is tied to their former spouse's retirement timeline and longevity. It also means waiting, sometimes for a very long time. The second approach is called the present value offset. An actuary calculates what the pension is worth today, in current dollars, accounting for factors like projected retirement date, life expectancy, interest rates, and the specific terms of the plan. The non-employee spouse then receives other assets of equivalent value, perhaps a larger share of investment accounts or real estate equity, in exchange for giving up their future claim on the pension. The offset approach creates a clean financial break, which many people prefer, but it requires a careful, professionally prepared valuation, and it requires that sufficient other assets exist to fund the trade. Accepting an offset without getting a proper valuation is a serious and surprisingly common mistake. One of the most costly misunderstandings I see around retirement accounts involves taxes, and it comes up more often than you might expect. People sometimes assume that if the court says they're entitled to a portion of a retirement account, they can simply withdraw that money as part of the settlement. The reasoning feels intuitive. The court ordered it. It's their money. But withdrawing retirement funds, even pursuant to a divorce agreement, triggers ordinary income tax on the full amount withdrawn, plus a 10% early withdrawal penalty if you're under 59 and a half years of age. That combination can consume a significant portion of what you thought you were receiving. The only way to receive your share of a retirement account without triggering taxes is to have it transferred properly. For IRAs, that means a transfer incident to divorce going directly into your own IRA. For employer-sponsored plans like a 401k, that means a properly prepared and executed QDRO directing the plan administrator to transfer your share. There's one narrow but useful exception worth knowing. If you receive a distribution from a 401k that's paid out pursuant to a QDRO, you can take that cash without incurring the 10% early withdrawal penalty, even if you're under 59.5. You'll still owe income tax on the distribution, but the penalty doesn't apply. This provision can be helpful in specific circumstances, particularly when someone needs liquidity during a financially difficult transition, but it has to be structured carefully and with full awareness of the tax impact. I want to spend some time on the mistakes I see most frequently because knowing what can go wrong is just as important as understanding the rules. The first and perhaps most common mistake is waiting too long to address the QDRO. I've seen cases where a divorce is finalized, the settlement clearly spells out the retirement account division, and then months or even years pass before anyone actually prepares and submits the QDRO. In the meantime, the account value has changed. In some cases, the employee's spouse has retired or moved to a different employer. In the most difficult cases, the employee's spouse has passed away, and the survivor benefits were never properly addressed in a QDRO. The time to begin the QDRO process is as soon as the settlement terms are agreed upon, not as an afterthought once everything else is wrapped up. The second mistake is accepting a settlement that treats different types of assets as financially equivalent when they aren't. A 401k with $100,000 in it isn't the same as a taxable brokerage account with $100,000 in it. The retirement account is pre-tax money. When you eventually withdraw it, you'll owe ordinary income tax on every dollar. The brokerage account, depending on how it's positioned, may carry little to no embedded tax liability. Treating them as equal in a negotiation means one party is absorbing a substantial hidden tax cost. This analysis matters, and it often changes the math in a settlement significantly. The third mistake is failing to update beneficiary designations promptly after the divorce is final. Retirement accounts don't pass through your will. They pass directly to whoever is listed as the beneficiary on file with the plan administrator. If your former spouse is still listed as your beneficiary and you pass away before you update that designation, they may receive those funds regardless of what your divorce decree says. Update your beneficiaries as soon as your divorce is finalized. Don't leave it on your to-do list. The fourth mistake is not getting a proper valuation of defined benefit pensions before agreeing to an offset. Pensions are actuarial instruments. Their value depends on multiple variables: projected retirement date, life expectancy, interest rates, cost of living adjustments built into the plan, survivor benefit provisions, and the specific terms of the employer's plan. Accepting a round number without having a qualified actuary, prepare a formal valuation is a risk that rarely benefits the person who accepts it. I want to speak directly for a moment to the spouse who didn't manage the retirement accounts during the marriage. This is often the person who stepped back from their career to raise children, who relocated for a partner's job opportunity, who supported a spouse through graduate school or a business startup, or who simply divided responsibilities in a way that left the financial management to someone else. There's nothing wrong with any of that. It's a very common pattern, and it reflects trust and partnership. But if that describes your situation, here's what I want you to understand. In California, you typically have rights to those retirement accounts. What was accumulated during the marriage usually belongs to both of you. The fact that your name isn't on the account doesn't necessarily change your entitlement to a share of the marital portion. Your rights only protect you, however, if you take the steps to enforce them. That means obtaining full disclosure of every retirement account, including current statements and the plan documents that govern each account. It means understanding what you're actually entitled to and not accepting a settlement that undervalues your share. And it means making sure the QDRO or IRA transfer is fully executed after the settlement, not just agreed to on paper and quietly forgotten. The financial foundation you build after a divorce depends in large part on getting the starting position right. Retirement assets are a cornerstone of long-term financial security. They deserve the same careful attention as every other asset on the negotiating table, and in many cases, they deserve more. I want to close with something that doesn't get enough attention in these conversations. What you do with your retirement assets after the divorce is complete. If you're receiving a portion of a former spouse's retirement account, that money needs to fit into a coherent financial plan for your future. That means understanding when you'll need it, how it should be invested in the meantime, and how it fits alongside any retirement savings of your own. If you're the person who had the retirement accounts and is giving up a portion of them, you need to assess how that affects your own retirement timeline and whether you need to adjust your saving strategy going forward. In both cases, the division of retirement accounts in a divorce isn't just a legal transaction. It's a financial planning event with long-term consequences. The work doesn't end when the QDRO is signed or the IRA transfer is complete. In many ways, that's when the real planning begins. If you're going through a divorce and have questions about how your retirement assets should be handled, I strongly encourage you to work with a certified divorce financial analyst before you agree to any settlement terms. The cost of getting proper guidance is almost always far less than the cost of getting it wrong.
Thank you for listening to Advisor in Your Corner. If today's conversation raised questions about your own situation or a client's, Alex Weinberger and the team at Marriage Financial Solutions are available to help. They work directly with individuals navigating divorce and alongside the attorneys, mediators, therapists, and coaches who support them. Every engagement is handled with the discretion, rigor, and independence the moment calls for. To learn more or get in touch, visit marriagefinancial.com. If this podcast has been useful to you, please share it with someone who could benefit and subscribe wherever you listen. This has been Advisor in Your Corner. We'll see you next episode.
The information and opinions presented in this podcast, including the views of guests not affiliated with Marriage Financial Solutions, is for general informational and educational purposes only and should not be considered personalized financial, tax, or legal advice. Marriage Financial Solutions does not provide advice regarding securities or the advisability of investing in securities. Marriage Financial Solutions is affiliated with Weinberger Asset Management, an SEC-registered investment advisor, and may refer listeners to Weinberger Asset Management when investment advisory services are appropriate. However, individuals are not obligated to use the services of Weinberger Asset Management.